Hello, everyone. This is Joe Zappia from LVW Advisors, and I thought that it would make sense for me to record a quick screen share video to talk a little bit about the announcement today with one of the holdings in our rising dividend strategy, ABBV, which announced today that they were purchasing Botox maker Allergan. For shareholders of AbbVie, today was a pretty nasty day. The shares closed down 16.25% to end the day at $65.72, which is at a near 52-week low. The stock has traded in a range of $65 to $100 in the past 52 weeks. At the current price, the stock trades with a PE ratio somewhere around 7 and a dividend yield of about 6.5%. Allergan, on the other hand, had a great day, traded up 25.36% to close the day at $162. So as of today's close, Allergan shareholders are pretty happy, and AbbVie shareholders are scratching their head. What I'd like to do is just take a look at the fundamentals of both companies separately and then together, and try to ignore the noise and emotion of current market prices around this deal. There's lots of news out there that AbbVie, because the majority of their sales come from the sales of Humira, which is coming off of patent, I believe, in 2023, and the Botox franchise, which is Allergan's flagship drug. The Botox franchise is limited in its scope and ability to continue to grow Allergan's earnings, that both of these companies are classic late-stage one-product pharmaceutical companies that don't really have much in the way of the upside. What I'd like to do is just simply look at the two companies from a valuation point of view and provide some perspective as to why I think it's a good value. We use fast graphs as a way to take a graphical look at how companies are valued relative to not only historical earnings, dividends, and other financial measures, but also future or projected measures based on analyst estimates. If you take a look at the chart for AbbVie, AbbVie has been a public company since roughly 2012 when it spun out from Abbott Laboratories. What I have on the screen here is a look at AbbVie's earnings growth. Earnings line is orange. So from the time of 2014 through 2018, which is the end of last year, AbbVie has grown their earnings per share from roughly $3.14 a share to last year they ended at $7.91 a share. And this year, there's several analysts that follow the stock that are estimating earnings of $8.80 per share, which represents 11% earnings growth over the prior year, with 8% growth projected in 2020 and 9% growth projected in 2021. So AbbVie has been a great growth company, and if we take a look at the dividend, the white line represents AbbVie's dividend. So AbbVie initiated a dividend 2013 of $1.60 a share, and they've been rapidly raising that dividend through the end of last year. They were at $3.95 a share, and currently are on a 12-month earnings track, a dividend growth rate, payout rate of $4.35 a share. So over the period that they paid a dividend, AbbVie has increased their dividend at an amazing 67% a year from the time that they've initiated. And they've done so without a meaningful increase in their payout ratio. In 2016, their payout ratio was 48%, 2017, 47%, and at the end of last year, just under 49%. So this is a strong and healthy company, an A- credit rating, a total enterprise value of roughly $130 billion that's shown earnings growth of 13.3% since it became a public company and has historically traded at about 14.5 times earnings. The nice thing about fast graphs, though, is we can overlay the current stock price over the traditional valuation measures for a stock. And as you can see, when you look at this, from 2012 through 2016, AbbVie traded in pretty tight correlation to its normal PE ratio of around 14.5 times earnings. However, AbbVie got overpriced, reasonably overpriced, trading at $116 a share, which was 19.4 times earnings. And as we see time and time again when we look at these fast graphs, companies that become very overvalued tend to underperform significantly in future periods. And likewise, when companies become greatly undervalued, they tend to have more upside than they would. Remember, markets are emotional. They're not necessarily efficient. So if we focus on the data, the underlying fundamentals of a company, the same way that Warren Buffett looks at companies, what we can do is we can make decisions when to buy and sell companies. So I would argue that before this deal was announced, AbbVie was trading at roughly $70 a share, $75 a share, with a PE ratio of 9 and a dividend yield of about 5.5%. But as of today's close, AbbVie is trading on a current PE ratio of 7.9 times earnings. Now, mind you, this is with projected growth of 8 to 11% pre-merger, and they're currently trading at a dividend yield of 6.5%. So when you look at AbbVie as a standalone company, you can argue that this company is cheap by almost every measure, and I think it's a fantastic opportunity for dividend growth investors to own a company like AbbVie. In fact, if we do some forecasting on AbbVie, if AbbVie were simply to trade back to its normal PE ratio of 15, it implies that at today's close, the stock has 71% upside between now and the end of 2020. So as a standalone company, AbbVie is really interesting. Now, if we switch gears and take a look at Allergan, the same chart, you can see that Allergan really had rapid growth from 2008, 2009, where they grew earnings from $2.43 a share all the way to $13.98 a share, which was peak earnings for this part of the cycle. And as you can see, there's a tight correlation, again, of the stock price of Allergan, which is the black line, and their traditional or normal PE ratio of about 18.5 times earnings, which of course is based on their growth rate. But Allergan, just like many companies do, got extremely overpriced at $331 a share. It was trading at 24.2 times earnings at the end of 15. And since then, the market's pretty smart. And since then, Allergan earnings flattened out and the stock price suffered and traded from $331 to a low of $194 at the end of 2016. Since then, Allergan grew earnings at 21% in 17 and had another pretty flat year of earnings of 2% in 18. Looking out to 19, 20, and 21, the market's not very optimistic about Allergan's ability to grow earnings, and that also speaks to why the valuation of Allergan is below that of its peers. But we would argue if you look at the company, you look at their recent dividend, and you look at the share price relative to their historical growth rates, you can see that I think that Allergan was a terrific opportunity, again, pre-merger or pre-merger announcement to make meaningful returns in Allergan. In fact, if one were to purchase Allergan before today, you could argue that the stock is really potentially a double if it were to trade back to its historical PE rate of 15. Probably not likely without an acquisition or some new product introduction, as the Botox franchise tends to be more late cycle. But when we look at this from a valuation perspective, Allergan is a cheap company with an enterprise value of roughly $76 billion after today's close. But prior to today's open, the enterprise value was roughly $65 billion, and Allergan is paying about $68 billion. So we could argue that Allergan is buying the company below or at its enterprise value, not overpaying for the company. So fast forward to the conference call today between the two CEOs of Allergan and AbbVie. A couple things they talk about. First of all, AbbVie is committed to, and this was in the deck, committed to using excess free cash flow to fund continued aggressive dividend growth and share buybacks while paying down debt and using excess cash flow for strategic acquisitions. They estimate that they can create about $2 billion in cost synergies between now and 2023, and that earnings will be accretive to the tune of about 10% in the first year following the close of the acquisition. So if there's any sort of executional uptick for these two companies, we think that there's actually some potential additional synergies. It's a relatively small purchase for AbbVie. In fact, AbbVie doesn't even need shareholder approval because I think the deal amounts to about 19% of the company's value. And the two companies put together represent an excellent value, strong cash flow, two flagship products, the ability to diversify that cash flow to purchase mid to late stage additional products or drugs, and at the same time maintain their strong dividend growth track record, which really puts AbbVie in the dividend aristocrat area as they've grown their dividend every single year since they were spun out from Abbott Laboratories in 2012. So as we look at this today, again, I think that there's terrific upside powerful profits to be made in AbbVie if this deal in fact does go through and the execution is done correctly. But there's a huge margin of safety, which of course I always like, in the sense that we're buying a company that is committed to continuing to not only maintain the dividend but grow it. We lock in a current cash flow yield today of 6.5%, buying a company trading at less than 8 times earnings, trading well below its enterprise value. And one last thing I'd make a point of is that AbbVie has done a great job growing its sales from 18.7 billion in 2013 to 25.6 billion in 17 to 28 billion in 17 and to 32.75 billion in as of the end of 18. But at the same time, since really mid 2018, the shares have been trading at less than a historical typical price to sales ratio, currently trading at only 3.6 times sales. So I look at these two companies and I feel pretty comfortable holding AbbVie. I think we'll be a buyer of AbbVie to average down our position, but we'll give the market a couple of days to settle down and see where the price settles. Make sure there isn't an additional suitor that comes in to attempt to take this company away from AbbVie. This is Joe Zappia from LVW Advisors, and I really thank you for listening.